Well, there we go. We are live on Facebook, and we've already got a few people who have joined us here on this beautiful Thursday evening. And that's if you're in Northern Virginia, because we have 79-degree weather and some sun today after about 5 days of rain. But welcome to our Homebuying 101 buyer training presented by the Ross Group here at Intercoastal Mortgage. This is meant to be interactive. There is a space on the side where you can type your comments in. Myself and the team here will do an introduction quickly, but we will be monitoring this chat. So if you do have anything that you want to ask, feel free to join in and ask, and we will answer those questions live here. We are coming to you live on YouTube, on the Ross Group channel, and also on Twitter or X, whatever you want to call it. And with that being said, I'll kick us off here. My name is Rob Ross. I'm Executive Vice President and Loan Officer here at Intercoastal Mortgage with darn close to 25 years experience with myself and 42 years experience with the team here and the crew. And you've got myself, Rob Ross, and I'll kick it over to Chris and then Alec just to tell a little bit about themselves here.
All right. Thank you, Rob. Yes, welcome everybody. My name is Chris Kearney. I have been with the Ross Group now for almost 11 years. That's a lot of homebuyer seminars. But we're excited to have you guys here today. And I'm a senior loan officer on the team, Rob's right hand, and excited to get this going.
Hey everyone, Alec Gagne. I am the left or right hand, depending on the day. And if Chris is dealing with his two beautiful children, and you're always here and happy to help. I'm a senior loan officer as well. I've been with the Ross Group for, I believe, coming up on 7 or 8 years, but it's like dog years. Might as well be 16. But ever since college, I was interning and progressed with the Ross Group and used to park our CEO's car back in college. And that's kind of how I got into the industry. But would much rather drive a Bentley than park it, and much rather be a member at a country club than be a valet for the rest of my life. So here we are.
Perfect. You've met the crew. And we will kick us off here with Homebuying 101. And this is basic entry level. So whether you're a first-time home buyer or second-time home buyer or 20th home buyer, you're still going to find some information in this that is, helpful to you. And we are going to talk fairly quickly to get you through this and make sure we stay within the hour time frame. We try to push this closer to 45 minutes. So without further ado, I'm going to kick us off here. We are going to start with this first slide. So the real estate process for buyers. Basically, you as a homeowner are probably at some point going to consider purchasing a home. That is kind of the first step. It might be you watching HGTV or one of these fun shows on TV at night as you're kicking back after a hard day of work, and you are just, your mind starts spinning and you're wondering if you should buy a home. Well, this is a great place to start here. And the first step, believe it or not, might be to contact a real estate agent. And if so, that's a great first step. But what you might not realize is an even better first step might be to work with a mortgage company such as the Ross Group here at Intercoastal. And if you're watching today and considering purchasing, we'd be honored to help you navigate through that journey. So the buyer would find a real estate expert to assist with the home buying process. You should work with someone who is a licensed professional. So we do highly recommend that. So a licensed realtor. You will then get pre-qualified with a team such as the Ross Group here. And then once we have issued your pre-approval, which to give you an idea, takes less than 24 hours. So from the time you do a free application with us and a soft credit check that does not hurt your credit whatsoever, we will issue that pre-approval within 24 hours. And to be honest, if it's urgent, we'll probably issue you that pre-approval within an hour. So it just depends on your time frame and the urgency of your home search. And once we issue you that pre-approval, we will forward a copy of that to your real estate agent that you are working with. And there's your golden ticket to Willy Wonka's Chocolate Factory. You are now out searching for a home, and you have that offer letter in hand. And that offer letter is what really helps you write an offer on a home. That's what you need, right? You can't go out on a Saturday and make an offer unless you have a lender that has basically certified that you can buy this home. And that's what we're here for. Once you find that home and you're working with your real estate agent and you've decided you want to make an offer, we will customize that offer letter to where you can give it specific to the property address and the sales price that you want to offer on that home. And we will also call the listing agent to give you a glowing endorsement to help strengthen that offer, to make sure that you are best positioning yourself to win that deal. And basically at that point, you secure your mortgage with a lender. Again, hopefully the Ross Group, we're here to help in 24 states. And we order an appraisal, we get your final documents, and you go to closing on what is called the settlement date. And on your settlement date, you will work with a local settlement company or title company, whichever you want to call it. And that settlement or title company is going to go through all the legal paperwork. You're going to sign your life away. You're going to sign things 2 and 3 and 4 times to make sure you know what you're doing. We've also reviewed that with you ahead of time, so it's not the first time you've seen those documents. And you are going to go to settlement, and your real estate agent's going to be very happy to hand you those keys to that brand new home. So that is really kind of how the gist of the process. But we're gonna pull back the curtains here a little bit and look and focus on the actual mortgage process today. The home buying process is the fun part, right? That's where you get to go out with your real estate agents and look at all the beautiful homes. Check out the kitchens, the bathrooms, the locations. That's the fun part. And I know we have a few of our realtor partners on here that we very much appreciate. And, we always say, you guys have all the fun. You get to show the homes. We have to tell clients, you owe us this much money monthly, and here's what you owe us at closing. So we're kind of taking the blood samples and helping you get into the home. But most people can't pay cash for a home. So a mortgage really becomes the most instrumental and most important part in this process. So we will go through monthly expenses, rent versus owning. We will tell you how to measure your buying potential. And we will go through some of the elements of the loan process today. Let's start with monthly expenses. And we're going to talk a little bit about rent versus owning. And hopefully this sheds some light on kind of the tax benefits here for you. And again, this is a basic example. So our disclosure, this is not necessarily where interest rates are today. These aren't necessarily the rates for your specific program. Those can vary, but we have to have some sort of example here for you. So let's take rent. Let's say you are renting a place for $3,500 a month. Well, that would be a pretty nice rental for a lot of folks. Okay. And let's say you're paying renter's insurance monthly for $50 a month for renter's insurance. And we can also help you with insurance. So we can tell you that at the end. We do run IC insurance as well, and we can help you with renters, auto, property, and casualty insurance. So anything from an insurance standpoint, if you need help, we can really help you out there as well. And then let's say you have utilities of about $250 a month. And let's say you're buying a property and that loan amount that you're borrowing is $500,000. And we're just using an interest rate of 7% today. For about the past 24 months, rates have kind of fallen between 6.5% and 7.5%. So we're splitting the difference and using 7% right now. Your principal would be $410, your interest $29.17. You can follow that chart there. Taxes, homeowners insurance, possible mortgage insurance, homeowners association fees. If you live in an HOA, maybe your community has a pool or a fitness center or a nice park or some landscaping that's taken care of. All of that might be part of your HOA. And then let's throw those utilities on there as well. So you have leasing $3,800 a month or owning $4,487 a month. Here's where the fun begins. Where you're looking at this going, well, it's $687 less to rent. So let's just rent. Well, we're going to tell you, let's look at those taxes. Let's look at that interest, and let's look at that MI, that mortgage insurance. And then we're going to say, wow, you have $200,000 in write-offs over a 5-year period. That's pretty substantial from a tax return standpoint. Now let's jump over and use a tax bracket at the bare minimum of 25%. And we're going to do a reduction in taxes, saving you $834 per month. Well, what does that look like now? Well, you're taking that 600 something you saved earlier, where you thought it was cheaper by $600 some to rent. And now we're telling you, hey, it's actually only 147 less to own. Well, let's knock both those out. Okay, so big red X's on those. And let's now look here at the 636 less per month, because you're paying down principal of $489 a month. So when you're paying down this principal here of $489 a month, you are now 636 monthly benefit by owning. So again, the payment looks higher, the payment is higher, but when you factor in your tax benefits and you factor in that principal pay down, you're really saving a lot of money. So what you pay for each month? Well, tax savings are immediate when you realize them. Depends. A lot of people will keep their withholdings the same, and you're going to realize that tax benefit of owning a home at the end of the year when taxes are done in April. You've done your taxes by April 15th, unless you filed that extension. And let's say you've not filed the extension, April 15th rolls around. A few weeks later, you're going to get a nice fat check in your checking, deposited directly from the IRS. And that is because of your home ownership. And that is because of the previous slides that we just went through on those tax benefits. Or you can change some tax exemptions with your IRS on your W-4, and you can take those exemptions and those tax benefits home on a monthly basis. If you work somewhere that has a great HR department, you might want to consult with them to make sure you're doing that properly, and consult with your accountant. Your principal savings are deferred. Obviously, the principal pay down, you're not seeing the immediate benefit of that in your checking account, but it's a beautiful thing when you look monthly and see your home value going up and your principal balance going down. That is eventually money in your pocket. So when we say that is deferred, it just means you don't have instant access to it, but it is your money and you are building wealth. So let's measure your borrowers. That's you watching here. Let's measure your potential, your buying potential. How do we do this? There's a few metrics to qualify, and we're going to kind of show you really the most important ones here. So it all starts with credit history. A credit score. If you see FICO, it's Fair Isaac and Company, but let's forget that. And let's just say it's your credit score. It's a little bit easier. And a credit score is very important. We'll go through that here in a little bit, so you learn a little bit more about that. That's the single most important thing to qualify for a mortgage. If you don't have the right credit score, it's kind of a stop before you start. The next most important thing, which I'm going to call 1A and 1B, credit, and then this, is the ability to repay. And that's your debt to income ratio. Okay. So you have to have some sort of income to qualify. If you don't have income, there are specialty programs out there for investors. There are asset depletion. There are cash flow statements. There's P&L options. There's all these different options out there, but this is Home Buying 101. So we're not going to tap into that today. But if you are listening and you have an unusual income scenario, please still call us and let's talk through that scenario. And then your wherewithal, your cash to close, your reserves after the transaction. We're going to be looking at all that stuff to make sure that you do and can qualify, and that you're going to be able to make those payments once you settle. So let's look at credit history to start. So all lenders nationwide are going to pull credit reports through 3 credit bureaus. And these are very popular names out there if you've ever had your credit pulled. They are Equifax, Experian, and TransUnion. Those are the 3. How it works from a mortgage company standpoint is we use the middle of 3 scores. So we don't use the average, we use the middle. So let's keep this simple. If you have 3 scores and it is a 700, a 720, and a 740, we use a 720. That is your middle score. That is how you qualify. That is how your loan is priced out. That is how your interest rates are determined. And we do what's called that soft credit pull that Chris put in the notes over there on the side. And there is no impact on your credit score by doing that. From a seller's standpoint, let's talk about the difference between a consumer score and a mortgage credit score. Okay. A consumer credit report is when you are going out opening a Target Visa card. A consumer credit report is when you are obtaining an auto loan. Or buying a mattress at Mattress Discounters. Whatever you're doing where you're borrowing credit, that's a consumer credit score. Those scores typically range 10 to 15% higher in credit score than a traditional score. So if we tell you your mortgage score is a 700, you might say, wait, I just had my credit pulled yesterday through Capital One and it's a 728. Well, that is correct. Your consumer credit score is a 728, but your mortgage credit score is a 700. And the reason there are 3 companies that have 2 scoring models is it's much more serious when you're obtaining a mortgage, because that target card might give you a $2,000 balance. That mortgage might give you a $500,000 loan. So you have a lot more on the line, and mortgage lenders have a lot more on the line. So it's a little stricter criteria when determining your credit history. Some derogatory events that could lower your score. You'd be looking at bankruptcy, foreclosure, short sales, judgments, collections of any type, medical, student loan collections, or late payments. The biggest thing I can say you can control here are those late payments, right? Those collections. If you have something, pay it on time, right? If you feel like you can only pay the minimum because it's a tough month or you didn't get that bonus, pay the minimum, but don't not pay it, right? And remember, you're not reported late until you're 31 days late for most purposes. Even if you're past 15 days late, you're still not going to be reported to the credit bureaus as late. You might pay a $20 or $50 penalty to the credit card company because you've paid 15 days later than they would like you to, or 16 days, okay? But you're not going to actually be derogatory from a credit standpoint till you hit that 30-day mark. So just make sure you pay those. Here's a little chart. I'm not going to read through this for you, but we'll start at the bottom, 400 to 580. That's considered poor. And let's go clear to the top, 800 to 850. That's considered near perfect. Really where you want to be is right in that middle range. That 700 to 719 or above pretty much opens you up for every product out there on the market. We as a company have a 580 minimum, so we are clear down on that bottom, even into the below average or poor box, right? We can hit you with the 580 credit score, and we can still get you into some really phenomenal loans, which Alec, I believe, will be talking about a little bit of those later. The weights of the credit element on the right there, you can see this kind of divided out. Credit history is super important. So when you're 57 years old and you've had credit cards since college, you're going to have a higher credit score. When you're 22 right out of college and you have 5 credit cards because you got a free t-shirt for signing up, your score might be a little bit lower. You don't have quite the length of credit history. New credit mix, all of that is a little less impactful when it comes to your credit score. With that being said, I'm going to go to the next slide here and kick it over to Chris Kearney, and he's going to start explaining ability to repay.
The fun part. So after we figure out your credit score and where that falls, because that is extremely important, the other 2 main pieces of the puzzle when we're getting you pre-approved is your income and your assets. So that's what we mean by your ability to repay. So we'll start off with the income. So these are, there's all kinds of different forms of income, whether it's as easy as a simple set salary or anything that's part-time, but there's all kinds of different, versions of self-employed income, rental, retirement. There's alimony and child support. I'm just reading these off to you, but I'm saying it because there's all different forms of income. What you need to know is the magic number. The magic number for just about all of these is 2. And what we mean by that is for basically any income source that you see on this list or that we'll talk about here today, you need a 2-year history of that income for just about all of them. Now, things that like a set salary or guaranteed hours, if you're an hourly worker, those can be used immediately. But part-time, self-employed, a bunch of the different, other different options, you need a 2-year history of that income for the most part. Next, the debts. So again, we look at the income and we look at assets, which we'll talk about, but we're also going to look at your debts. What current debts do you have other than the mortgage that you're trying to qualify for when you get pre-approved? We look at all of the other obligations that you have that come through on your credit report. So this could be other homes that you own, but more often this is credit cards, student loans, things of that nature. And so we'll see all of that pop up on your credit report, and we factor that in to your qualification. Something to note here is that we factor in what the minimum monthly payment is on these credit cards or your student loans. Student loans, of course, being a big one and a hot button issue right now. Some people will come to us and say, oh, I have $20,000 or $60,000 of outstanding student loans. Is that going to hurt me? But if you're on an income-based repayment plan, or just depending on the terms of how you're paying those student loans, you may only have to pay a couple $100 a month, in which case it doesn't affect you as bad as you may think. So we focus more so on the minimum monthly payment that you owe on these debts, and not as much the total outstanding balance. Both are, of course, are important, but that's something great to make note of. It's most lenders will focus on what your actual monthly obligation is in terms of your debts. So what we look at now, the excess of income to debt. So we look at what payment obligations are not considered to be monthly debts. What do we not count? When we pull your credit, we see credit cards and student loans. These are things that we don't count. So existing utilities that you pay for in your current housing situation, where you choose to go out to dinner every weekend, or if you're like Alec and you go out to dinner during the week all the time too, what does your restaurant bill look like? We're not going to look at that as much, and that doesn't affect your qualification.
No kids.
Lucky for Alec on that one. But no, so we don't look at, your daily expenses of that nature. That doesn't come through on the credit report. That's not anything that we would track or that affects your buying power necessarily. At least in terms of a monthly debt that we would count. Now, here is a good slide to either take a picture of or write down. This is a huge piece of the puzzle for us as lenders. So when we look at your income, we look at your debt. It's a very complicated formula, as you can see. No, it's not. It's your debt divided by your income, literally. So again, that goes back to the monthly obligations that I mentioned earlier. So literally on one side, if you're sitting there at home trying to figure all this out on your own, here's a way to do it. Line up all of your debts on one side, the monthly payments, so minimum monthly credit card payments, student loans, etc., on one side, and your mortgage payment that you're qualifying for with us, the Ross Group, and divide those debts by your monthly income before tax. So that's how we come up with your debt to income ratio, all of your debts divided by your income. And based on what that ratio is, will help us as the lender decide or, figure out what you qualify for, what programs. All right. Next, moving on to the assets. So we talked about income, we talked about debts. So let's talk about the assets, funds that you will actually be bringing to the table which can include your down payment, closing costs, escrow, you name it, right? So in terms of assets, there's, again, all kinds of different sources where this can come from. The most common, of course, being just, your checkings and your savings accounts. Or, stock accounts, money market, if you have financial, advisors, things of that nature, liquid funds in bank accounts, very common, but there's plenty of other sources too. So if you're selling other properties, if you're liquidating some of these investments, like, stocks or Bitcoin in some cases, just depending on what your portfolio looks like. Gift funds is a big one too. So folks who are getting help from family, mom and dad, or family member, whoever it is, if you're getting gifts from other folks in your family to help with the down payment or to help with the transaction, you can do that. And we can coach you through how to do that in the most, I should say, the least hassle, doing it in the easiest way so that it makes life easy for everyone. Non-liquid assets, things that, we may not necessarily need for your down payment, but things that can help strengthen your file. That can include like retirement savings or investments in securities, things of that nature, where maybe you don't necessarily want to pull money out of those accounts. But sometimes having those accounts in your file can help strengthen your overall profile. But we can talk about that on a case-by-case basis. All right. Here are some unacceptable sources. So, we just went through the list of, of different sources that, are common and are used, in the day-to-day transactions for a mortgage. Now, here are things that are unacceptable. This may sound silly, but bringing physical cash to the transaction doesn't work. We actually just ran into this maybe a week or two ago, where a client just had money in a safe, or mattress money, as the presentation will say. You cannot bring cold hard cash to this transaction. The money has to be seasoned in a account of some kind, whether it's again, a bank account or stock account or brokerage account, whatever it is. So mattress money is not usable. It cannot be traced by underwriting. Okay. Now, cash deposits from a business account, they can't be used either for most programs, but that one's more of an asterisk, where, depending on your program and what type of business you own and what percentage you own, there's ways to do that. But for the most part, cash deposits from a business account would not be able to be used, especially if it would adversely affect the operation of your business. So that's a specific example that we look at. Others, proceeds from unsecured loans. Again, that could be, like just money you get from a friend, or money that you get from a source that we can't track or trace. Those are unacceptable. Stocks in unlisted corporations. I would say the other highlight on this one is funds held in a foreign bank. We're here in the DC metro area. There are people from all over the world that are interested in real estate in this area. So sometimes funds can be coming from all kinds of different places. When money is in foreign bank accounts or in foreign institutions, we need that money to be transferred to a local using air quotes, into a US account, and have the proper seasoning, which is usually 2 months. So that's an important one, especially around here, just, with how much, how many different people are interested in buying real estate and where funds can come from. So moving on. I kind of hinted at this earlier with the income, but it applies for assets too. That magic number I told you guys about, 2. For income, it's 2 years for a lot of cases. For assets, it's 2 months. So we would need a 2-month window. And when I was talking about the seasoning requirements and foreign, transferring money from foreign accounts, the seasoning requirement just means funds have to be in an acceptable source for 2 months. Okay, so that 2-month window is very important. Also very important are the asset statements. This may sound basic, but you would be surprised how often we get account statements that do not have someone's name on it or do not have the actual institution information on it. We need that information. We need to be able to track and trace where exactly funds are coming from. Bless her heart, I had this client that I was working with not too long ago, and she just couldn't figure out how to print the right statement. So the statement that she did give me that had no name, no address, nothing, she just asked if she could write her name on the bank statement, so that could verify that it was her. Of course, that is not acceptable. It does have to be, an official statement from the bank or from the institution. All right, understanding the loan itself. So there's all different kinds of loans out there, and that is why getting pre-approved is so important. If you're watching this, you already know, but getting pre-approved is so important because of all the different options that you have. So there are options in terms of how long it takes you to pay back your loan. So the most common being a 30-year fixed, but there are 20-year and 15-year and others. There's even 10-year options that are out there. And depending on how quickly you want to pay this loan off or what your monthly payment is going to be, or what you want it to be, that can affect which of these types of options that we choose. The most common being the 30-year fixed, okay? Now, when you're getting pre-approved, you can also have access to see your amortization table. Your amortization table, this is funny when you're at closing. One of the documents is this amortization table, which maps out every single payment that you will have with your loan from start to finish. So if you do a 30-year fixed, 360 months, 360 payments. So your amortization table will literally be a table, a chart that maps out all 360 payments to show exactly what you pay every step of the way. Now, if you say, well, Chris, I'm getting a 30-year fixed, I know what my payment's going to be every single month. You're right. But what the amortization table will do is show you the difference between, let's say your total payment is $3,000 a month. It'll show you how much of that $3,000 a month is going towards principal and how much is going towards interest every single month, because that difference does change over the life of the loan. And let's go to the next slide. You will see exactly that. So this is a table, a screenshot of what an amortization table will look like. So this is, going based off of a month, a year total. But as you see, the amount of money going towards interest is a lot higher in year 1 than it is in year 30, right? But you're still making the same payments every single month. This is a 30-year fix, assuming 7.375 of an interest rate, just to use an easy number on this one. So even though your monthly payments are the same every step of the way, you have in year 1 $36,000 and $36,717 going towards the interest. And that changes over time. So less and less goes towards interest and more goes towards principal. Okay. Now, the relationship between rates and points. So you can pay points to lower the rate, lower than where the current market is. So points are a one-time charge. It's a one-time fee. Think of it as another closing cost. You pay it once and it lowers your rate for the entire life of the loan. So if it's a 30-year fixed loan, you're lowering your rate for 30 years. The more points usually means the lower you can reduce your rate. But I would say on the points thing, talk to your loan officer, talk to us, the Ross Group, about if paying points makes sense for you. It depends. It depends on how long you're going to be in the home. It depends on how quickly you break even. And we can talk, through all of that based on your individual situation. All right, different rate types. So I've already kind of talked about the 30-year fix, just because that's a very common loan option and loan program. But the fixed rate options, obviously great because your rate's not going to change, right? That's the whole point of a fixed rate, is having that security, knowing that your rate will never change unless, of course, you refinance and if the market gets better, all those things which we can help you with. So less risk. Now, adjustable rate mortgage, an ARM. That is different, meaning that your rate is fixed for a certain amount of time, but then can adjust based on where the market is at a later time. So obviously that type of loan comes with a little more risk. You don't know what your rate's going to be the entire life of the loan. It's broken down into segments. So we're going to talk about ARMs. I believe that is on the next slide here. It is. It's like I've done this before. So ARMs there's different options, right? So it's not just one ARM out there. There's all kinds of different ones. Usually they come in increments of 5-year, 7-year, or 10-year. Now, this is all, for the most part, 30-year loans. So we're still talking about a 30-year amortization. So you're still paying the loan off in 30 years, but interest rates for an ARM, let's say it's a 7-year ARM, your rate is fixed for the first 7 years. And then after that first 7 years goes by, the rate can adjust annually or semi-annually depending on the program. Okay. So why would you do that? Well, The reason to do it is because ARM programs usually will have better interest rates, right? So that risk of only having your interest rate be fixed for 5 or 7 or 10 years, the risk of that changing in the future becomes worth it to buyers when they say, oh, instead of a 7% on a 30-year fix, I can get down to 6.25, 6.375 on an ARM. We talk through those numbers. And again, it's all about your comfort level. It's all about your budget. We tailor all of this, to make sure that it fits what you're looking to do. But ARMs are coming back. They're very popular right now. We're doing a ton of them for folks that are comfortable going down that path. Something else to consider, or that we consider, is the loan to value. So the loan to value is basically a number that tells us what your down payment is, right? So the loan to value is the amount of loan, and the down payment is the amount of money that you're bringing. So if you're bringing 20% down, the loan to value is 80%, right? You're borrowing 80% from your mortgage and you're bringing 20% in cash as your down payment at closing. Okay. Usually for most programs, the highest loan to value that you'll see is 97%, which means what? 3% down. So usually 97 is the highest, but that depends on a bunch of different factors that we go through with your pre-approval. There are some programs, and guess what? We have them here at the Ross Group that'll let you go up to 100%. Yeah, that's right. No down payment. There are programs that are great for low down payment or no down payment options. So we can help with all of those different things. And now I believe Alec gets the next section here for different types of loans.
Well done, gentlemen. Go get a drink of water, Chris. That was a lot of talking. This is probably my favorite part as a loan officer, is being a loan technician. And it is our job to find the best box to fit you within, to have the cheapest monthly payment, accomplish your goals, least amount of money out of pocket if that's your goal. And we're going to kind of run through some of the stuff that we offer. Intercoastal, we definitely pride ourselves on having every loan product underneath the sun within our product suite. So within that, there's government-backed loans such as FHA, VA, USDA, VHDA, and we also work with all the state bonded programs. So we got DC Open Doors, Maryland Mortgage Program, West Virginia Housing, which is actually an incredible product. We actually just closed a few of those as well, in North Carolina, South Carolina Housing. Quick note on VHDA, I actually just sent out a pre-approval for a client looking to utilize VHDA, and Chris just mentioned 100% financing. In some scenarios with VHDA, you can go up to 101.5% financing, meaning your down payment is covered plus 1.5% of closing costs. So, in that scenario, they were also getting a seller credit. They came to the table with $0. It's crazy. So there's a million different options out there. And then on the other side of the fence, we also have, conventional financing. So, Fannie and Freddie, the plain vanilla stuff, which is also a great option for many people. FHA loans, this is a really great product for people that have, I would say, a 700 credit score or below. And the max loan amount in our area, so Northern Virginia, can actually go up to $1,209,750. And you can do as little as 3.5% down all the way up to that loan amount, which is insane. Now, FHA and VA, which we'll get into in the next slide, it's very generous when it comes to credit score. So Rob had mentioned down to that 580, that's going to be an FHA or a VA loan. But we're also very flexible with debt to income ratio tolerances and other guidelines alike. The cool thing about FHA is if your debt to income ratio is at a 54%, your mortgage insurance on that is going to be the same if it was 20%. Again, this is a great option for people, again, lower credit scores and higher debt to income ratios. But again, down to 580, it allows us a lot of flexibility, and same with VAs as well. The Ross Group, we definitely pride ourselves on our VA loans. We all come from military families. We definitely love helping our servicemen and women, and our VA rates are extremely, extremely good. It's the one thing the Veteran Affairs got right is their loan product. It's the best thing on the market. If you qualify for a VA loan, that is going to be the route for you. The rates are the lowest. There's no mortgage insurance, depending if you're 10% or more disabled. You don't have the funding fee. And again, still carries that government flexibility of higher debt to income ratio, lower credit scores. And you can do 0% down up to any sales price. So again, based off of entitlement too. Into the conventional space, so Fannie and Freddie. In the conforming space, and there's two different tiers of loan sizes per se, is there's going to be a conforming and there's going to be a high balance conforming or super conforming. But that conforming limit goes up to 806,500. You can do as little as 3% down up to that loan amount. And then up to that high balance 1209, you can do as little as 5% down, which you'll see right there. Anything north of the 1209,750 loan amount is now going to be considered a jumbo loan. And with jumbo loans, we really do need your blood samples and hair follicles. They are harder loans to qualify for, just due to the law of large numbers. And typically expect 20% down for your best rate and term on those. But we do have some portfolio financing going down to as little as 10%. And we love the $3 million loans. We wish we came across those more, but we have some 80% LTV options up to that level. The loan process, how do we get you from here at our home buying seminar to home ownership? So, when we get a referral, which we are so deeply appreciative from all of our referral sources, we're going to spend a lot of time on the education part in our initial consultation, which is going to be a phone call or a Zoom, whatever your preference is. And we're going to kind of take an initial look under the hood to understand what your goals are and structure something that's going to be most financially advantageous for you. After that, we're going to send you our link to our online application. Again, Rob had aforementioned, it is free, no obligation. We do soft credit checks, which is a huge plus. And depending on your overall financial profile, if you're self-employed, we're always going to get your income your tax returns in front of our underwriters, because we want to make sure that we have their stamp on your income, because the tax code can be very creative and we have to use what's on the paper. Once we have all of that, we're going to send you your pre-approval letter and estimate. As Rob said, that's our golden ticket to the chocolate factory. That's happy hunting. Go find a home. And we're going to take another layer of education with you at that point and walk you through the estimate line by line, item by item, and make sure you understand exactly where things are coming from, what they mean, why you're paying them. It's the largest financial transaction in most people's lives. So we really want to make sure that you're not being blindsided by anything. And again, you're in full comprehension. We're happy to explain it 10 different times. So happy hunting at that point. Okay, Rob we're on a roll here.
We can go back.
Yeah. You're finger happy with your amount.
Yeah.
But
let's go.
So then, we get under contract at this point. So you found a home, you ratified. We're pushing you into the next steps of full approval. Now, this is processing, underwriting. You're submitting all the stuff that our underwriters are asking. We're securing an interest rate at this point. You satisfy everything. We have full clear to close loan approval. Amen. We're super excited. We're going to settlement. Charges to the borrower. So obviously the purchase price, nothing's free in this world. You're going to have to buy this asset, per the purchase price that was agreed upon. Closing costs, you're going to expect those to come from the lender. So we only charge an $850 processing fee and $750 document review fee. Those are the only fees out of the entire transaction that comes from Intercoastal Mortgage. Everything else you see is going to come from title or settlement company, and then Uncle Sam. So think of it as sales tax. Part of what goes into your cash to close in addition to that is not a closing cost, but this is going to be your prepaids. So this is when you're going to establish a side pot of money called an escrow account, and that's going to essentially allow the servicer, so who you're making your payments to, pay your real estate taxes and your homeowner's insurance when they come due. So again, that is not a closing cost. You have to pay real estate taxes. You have to pay homeowner's insurance anyway, but the servicer is going to send that out on your behalf. And then when the loan is paid off or refied or sold, you're going to get a check back with what's in your escrow account. Credits for the borrower, third-party contributions. So depending on how generous Rob is feeling, and he's always a very generous man, we're talking about lender credits. Maybe we're covering our lender fees. Depending on the property that you're purchasing, if there's not as much competition, we're seeing a little bit of softening depending on the property. Maybe the seller's paying for some of your closing costs or all of them. That's something that you would kind of help your real estate agent would help negotiate. And then I won't comment on realtor credits or contributions. That's out of our lane, but you can get credits in that capacity. And then here's just kind of an overall breakdown. This is a really small snippet of what an estimate would look like. So you're going to see on the right-hand side to calculate your cash to close, your purchase price in this example, $500,000. You're going to see an addition sign or a plus next to your closing costs. You're going to see a plus next to your prepaid items, and then any prorated amounts due to seller. In that scenario, the total amount due in the transaction is $520,325. Okay, but remember, you're borrowing money. So your mortgage is going to deduct from that 520. So you're going to see your loan amount of 450. You're going to see your earnest money deposit, which is your money, but it goes into the transaction to show the seller that you are serious about buying the home. In this scenario, the seller is also giving you $2,000. And that's going to come out with your total cash due at settlement. So this is what you're wiring to the title company a couple days prior to settlement, is that $62,000 and change. Post-loan process. This doesn't concern everyone as much, but we're here once your loan is closed to advise you on what your first payment date is, when it's being transferred to a new servicer. Again, changes nothing to your interest rate or your term or your overall structure of the loan, just changes who you stroke a check to, right? And then, sometimes your loan can be sold more than once, but we're a lender for life. And, one thing that we always like to talk about here at the Ross Group is, when you are closed on your purchase, we're not going out of your life, because like most doctors, you want to get an annual checkup or a semi-annual checkup. We're monitoring the market, and we're monitoring what interest rate you closed at. And we're going to be beating down your door if there's an opportunity to refinance. So, the post-loan process, you can't get rid of us. We're always going to be here to help you out. Questions? Thank you for listening.
All right. Well
done.
We've lost a few folks on here, but we've maintained 5 or 6 viewers throughout, and we've had several viewers out there today on our social media platforms between Facebook, LinkedIn, YouTube, Instagram, and X. So we have added a few as we were going. We got a shout out from 365 Things to Do in Loudoun County. There's about 8,000 folks over on that page. So check that out if you live in the Northern Virginia area. Great page with updated things to do in Loudoun County, Virginia. And that's that. I said we were trying for 45 minutes. We made it to 48 minutes, which I think is a record time for us. But we are always here to help. You know where to find us. We have posted our website, which I'm going to post up here as well. And you can see it right up there on the screen, superlendingteam.com. You can find our information. That is our website. You will find our emails, our cell phones. Call us, text us. If you can figure out telepathy or smoke signals, try that as well. But we're always around to help out, and we would love to help get you into your new home. If you're a real estate agent out there and have been watching today, we would highly encourage you to join this 2 months from now. We do this every 2 months, and we would highly encourage you to send this to your database. Send this to your database of home buyers that are out there that might be thinking of purchasing a new home, and invite them to join the webinar. This education is key. It's what honestly gets people's appetite interested in purchasing a new home. And education is the key to the whole thing, right? People are going to be scared to buy a home. And unless you're out there and we're out there educating them, letting them know that it is easy, it can be next to nothing if you qualify for some of our 100% programs. Get a seller credit, get a lender credit. We've had some people come to closing with under $1,000, right? Total. So you can't buy 4 new tires for that in today's market. So, if you can get into a home and we can help you do it, we'd love to try that. But we are the Ross Group. We're always working together to serve you better. And we will see you here in a few months on our next webinar. Have a good evening.
Team.
Bye, guys.
Take care.
See ya.